So we are coming to look at consolidated statement of profit or loss. Okay, so we looked at statement of financial position, and we are going to be looking at statement of profit or loss. So the statement of profit or loss, it can be a full year acquisition, it can be 6 month acquisition, it can be 3 month acquisition. Though, if you are going to be consolidating, you only consolidate the parts of the profit that the parent will be having a share of. So if, for example, if the financial year for the subsidiary is January to December, okay, and the parent acquired a subsidiary on July 1, okay, so it means that from January to June, the parent will not have any share of what? The profit for that period. Okay, so the parent will have the share of the profit from July to December. So the parent will only consolidate the portion of the profit or the portion of the trading activities that they are going to be having a share of. So you always have to look at the reporting date and then the date of acquisition. So the pre-acquisition period, we don't consolidate that because the parent will not have a share of those profits. The parent will not have a share of those profits. But from the date of acquisition to the reporting date, that is the period, the post-acquisition period, the parent will be having a share of the subsidiary's profit. So we consolidate that particular part. It's just like what you do under the net asset. You determine the return earnings of the subsidiary at acquisition. So that one, the parent will not have any share of it. So you see that we only have the share of the post-acquisition period, which will be from the date of acquisition to the reporting date. So that is what we do for the profit or loss, the consolidated statement of profit or loss. You have to take note of what? The reporting date and acquisition date. So you ask yourself, when was the acquisition done? And when is the reporting date for the what? For the subsidiary. We only consolidate the subsidiary and then the parent. Associate is not part of the group, so we don't consolidate associates. So they might give you 3 statements. We have the parent, we have the subsidiary, and we have the associate. We don't add the associate figures because the parent does not have control over the associate. So it's only the parent and the subsidiary we are going to be consolidating. But the parent will be having a share of the associate profit. That will be shown as income for the parents. So we are going to pick a question on that. And for profit or loss too, we add the items line by line. The parent items will come. Then we add the portion of the subsidiary item that they are going to be having a share of. So let's pick question number what? Statement of profit or loss and OCI. So let's pick question number 1. Question number 1, who is the parent?
Green.
Okay, so you don't have to do anything. Just go ask yourself, what is the requirement? They are asking you to prepare a consolidated statement of profit or loss and statement of changes in equity of Brain Group for the year ended 31 December 2022. So don't waste time. Just come and put the heading there. Pick the parent figure first before you come and look for the date of acquisition. Okay, so we are going to be having the Brain Group. Okay. Statement consolidated. So we have the consolidated statement of profits or loss and other comprehensive income for the year ended 31 December 2022. So what will be the first item that will come here? If you are preparing statement of profit or loss, what is the first item?
Revenue.
Okay, so you have your revenue. The revenue, you go and pick the parent revenue. Then you have the cost of sales. Okay. Then you have your gross profits. Okay. The gross profit, you can go and check whether you have other incomes. If there are no other incomes, then you can arrange them anyhow. You can bring administrative expenses before the other incomes. Nobody will do anything to you. But let's see whether they have. So gross profit distribution, administrative, investment income, finance cost. So you also look to the question and see whether you have whether there is an associate. Okay. So we have admin expense, distribution. So we have the admin expense, distribution cost. We have the investment income. Investment income, what again? We have the finance cost. We have the finance cost. Please, you can bring the share of associate profit. If there is no associate, you can just put 0 over there. Okay. Sometimes the item given to you, there will be other items that will be coming. So maybe you can scan through the question to see whether there is an associate. Or if you are doing it, just write share of associate profit there. If there is no associate, you can just go and put 0 under the 0 attached to the share of the associate profit. So we have the share of associate profit. So we have the profit before tax. Profit before tax. Then we have our tax expense. We have our tax expense. Then we have profits after tax. So let's go and see whether we have any other comprehensive income item. No. So just leave it like that. There might be an item that might come there. So that is it. The statement of changes in equity will come there. But for now, let's focus on the. All right. So what is the revenue for? Let's keep 3 zeros at the top. Okay. Let's keep 3 zeros at the top so that our workings will be very simple for us. So this one. What is the revenue for the parent?
4680.
Okay, so we have 4680. So you have 4680. What is the cost of sales?
$3120.
Okay, 3120. Please leave the gross profit. The gross profit, if you do your workings very well, you subtract your cost of sales from your revenue, you are going to be getting your gross profit. So we don't bring the gross profit because that particular gross profit has been ascertained without taking into consideration certain items. Okay, so let's come to the administrative expenses for the parents. Administrative expenses what?
440.
Okay, 440. Admin is 440 and distribution is 260. The investment income is 136. Finance cost is what?
200.
Okay, 200. So you have your 200 here. Let's go to tax expense. What is the tax expense for them?
240.
240. So this for the profit, after we have done the workings very well, we are going to be getting those figures. So the next thing that you have to go and look for is that go and look for the acquisition date of the subsidiary. So we have December. So let's go to the footnote to look for the acquisition date of the subsidiary. Where can we get such information?
A.
Okay. This should be 80,000, not 800,000. Sorry. So let me modify that and bring it should be they have acquired 3,000 out of 80,000. Okay. Okay. So we are not interested in the number of shares that they are acquiring. The group structure, although we are going to do the group structure, but that is not our focus for now. Okay. So we have so when is the acquisition date?
1st August.
Okay. So 1st August to 31 December, how many months is that?
4 months.
5 months.
It's 5 months.
Okay, 5 months, isn't it? August, September, October, November, December. So what we do is that the question will always tell you that, okay, sometimes they can give you a pre-acquisition figures. Then you have to subtract from total figure. You also have to pay attention to that. Sometimes they can give you a pre-acquisition statement of profit or loss for the subsidiary. Then you have to take those figures from the total figures. The figures that you are going to be seeing in the statement of profit or loss are for the year. So you take those figures from it to get the post-acquisition. Or if you are not given that, the question will always tell you that you should assume that the profit or loss of the subsidiary are accrued evenly throughout the year. So what you do is that the profit or loss items over there, they are equal every month. So you just find a proportionate of the month that you are looking for. So let's go to the revenue for the subsidiary. Our revenue we'll find only 5 months of that. So 5/12 multiplied by the revenue for the subsidiary. What is the revenue?
2,400.
Okay, so 2,400. Okay. Let's come to the cost of sales. It will be 5/12 multiplied by what are you having?
1,200.
Okay.
Sabrina,
Yes, please.
please, aren't we going to work it outside before bringing it?
If you want to do that, that's supposed to be your own computation. But for me, I don't have the energy to go and do that. You can do everything in the brackets, they will mark it for you. You can only go and do the workings if you realize that no, the items that you are bringing, the space cannot contain them. Okay, so we have the administrative expenses to be 5/12. If you go and do the working somewhere, nobody is going to punish you. They will mark it for you. But someone who is doing it like this, the person will be saving time as compared to you that is doing it one by one and bringing the figures here. Okay, so let's have administrative expenses is what?
270.
Okay, So are you sure? Distribution cost comes first before that one. Okay, 270.
Mm.
Okay. So plus 5/12 multiplied by what?
180.
180.
180
Okay. So finance cost for them is what?
is 210.
Okay, 210. The tax expense is what?
Is 135.
Okay. Okay. After doing this, then you are in a comfortable lead now. Okay. Please, if you are doing statement of profit or loss, we don't prepare net asset at reporting at acquisition. What are you preparing the net asset for? The profit that they are going to be sharing, you will get it from the profit or loss account. So we don't prepare net asset at reporting. The only net asset that you can prepare is at acquisition to know your goodwill. That is if you are given a percentage to find impairment on the goodwill. But if you are given impairment figure, you don't have to do any calculation for the net asset. What I'm saying, let me see whether the question that we have over here, you are giving the impairment in percentage or you are giving so let me say the policy of the entity is to measure non-controlling interest using proportionate of net assets. Okay, the goodwill is determined to be impaired to the amount of 5,054,500 on 31 December and to be charged to cost of sales. You don't have to go and do any workings for net asset unless the question is asking you to calculate the goodwill yourself. Because the only thing that you need to calculate using the net asset is goodwill. Okay. But now they have given you the goodwill, the impairment of the goodwill. So you don't have to go and do anything. Nobody is asking you to prepare or to calculate a goodwill. You can only do the goodwill if you are being asked to calculate the goodwill, or you are giving impairment of goodwill in percentage. So if you want to know the impairment, you have to calculate the goodwill first before you know the impairment. But this one, the impairment has been given to you straightforward. So whatever they are using for the goodwill, the non-controlling interest is none of your business because we don't bring non-controlling interest to profit or loss. And the question is not asking us to bring what? The statement of financial position, but non-controlling interest will be important over here because of the statement of changes in equity. So we'll be showing the non-controlling interest in the statement of changes in equity. So we do that particular working later. But let's take the footnotes A in full. Let's take the footnote A in full.
Okay. On 1st August 2022.
Sorry, I'm coming.
Okay.
Okay. So let me come here and have the Grain Group consolidated statements of changes in equity for the year ended. You also use the year there, but I'm not here to do this one. So what we do is that for this one we show only two. We show the parent holding. So you show the parent holding because anything concerning the subsidiary will be absorbed into the parent. So we show the parent holding and we also show the non-controlling interest. So we show the parent holding and the non-controlling interest. So let's have our figure here to be this. Our figure here to be this. Okay, let's see whether we can get the balances. What is the equity balance for the parents? The net assets. The net asset for the parent is what? Statement of changes in equity.
2,500.
Okay. You see that one, the equity shares together with the retained earnings, other reserves, they are all included in this one. So you just bring the balance brought down for this. Balance brought down should be 2,500. This is including retained earnings and everything. We'll do workings for the non-controlling interest and bring that one later here. So let's go to the workings now. So you have our workings. Under the workings, you will be doing the group structure, which we all know how to do. So you do your group structure here. Okay. You do your group structure here. Then a group structure, you do your net asset. Why do you have to do the net asset? We want to know the non-controlling interest so that we take you to the statement of changes in equity. So let's come to this one. This one will only be at acquisition. Okay. We are not doing reporting because we are going to know the profit that will be shared from the statement of profit or loss account. So you start with their net assets at acquisition. What is a net asset at acquisition for them at the beginning of the year?
One
One
six.
1,665.
165. Okay. 166. Okay. This is January, isn't it? Okay. But they have been acquired at when? 1st August.
1st August.
Okay. So it means that we need what? 7 months profit to add so that we can get our total net asset at acquisition. So what you do is that when they have not given us when the dividend has been paid, so there is no pre-acquisition dividend over here. We assume that the dividend has been paid at the end of the year. So that will be a post-acquisition dividend because the question is telling you that the share, a minute. So the dividend paid is 160. And the question is telling you that the investment income over there is a dividend share for the parents. Okay. So that will be a dividend share for the parents. So let me check that one. That is a statement somewhere there. The investment income, which is shown in Brain Limited statement of financial, represent the dividend received from the LA and also dividend received from portfolio of other equity investment. So they are not saying anything about what? They are not saying anything about pre-acquisition dividends. So what you do is come and find 7 months for the profit for the year. So they have done 7 months before we acquire them. So the post-acquisition profit will be 5 months. 7 months will be pre-acquisition what? Profit. So let's go to that place and do our profits. So this net asset is at the beginning of the year. We need profit for 7 months to be able to get our, so that will be 405,000. 7 months of the profit to be able to get our net asset at 1st August 2022. All right, what are we getting?
236.25.
Okay. So this one, it means that keeping the 3 zeros, we are going to be having some decimals, but let's thank God that the decimal. Okay, so we have 236.25. Okay, let's go and see whether we are going to be having some fair value adjustments. So let's go to issues with fair value adjustments. Where are you? Okay, so let's take the question 1. Let's take the footnote now. If you have any fair value adjustments, we come there and look at it. The A.
On 1st August 2022, Brain Limited acquired 60,000 and 80,000 one city equity shares in Dela and gained control of Dela. The purpose consideration include an agreement to pay a total 162,000 in cash to the former shareholders of Dela on 31st July 2023.
Okay.
Brain
Okay. Finish that one.
Brain incremental borrowing rate on 1st August 2022 was 8% per annum.
Okay. So let's. I'm coming. We will look at. I want to change something there. Okay. It's supposed to be 60,000 of the 80,000 shares, not end. The person who typed the question, the mistake is too much.
Signalanos.
I can hear you, Sina.
Yeah, is it the purchase consideration or the purpose consideration?
Which one? The word is saying
After the one city equity shares in Dela and gain control of Dela, the purpose, I think it should be the page or the purchase consideration.
all right. So let's look at the percentage holding. What will be the percentage holding? What will be the parent percentage holding?
It's 8.
What will be the parent percentage holding in the subsidiary?
75.
Okay, that will be 75%. NCR will be 25%. Okay. The purchase consideration includes an agreement to pay the total 162 million in cash to the former shareholders of the LA on 31 July 2023. Brain's incremental borrowing rate at 1st August was what? 8%. What type of consideration is this?
Deferred.
Okay. So what we do is that you have to ask yourself, what would be the present value of this? So let's find the present value of the consideration. So the fair consideration, the present value of the purchase consideration, present value of the purchase consideration. Okay. Let me write the purchase consideration. Okay. So let's put present value here. So we are buying the shares, we are acquiring the company, we are acquiring 75% of the company on what? On 1st August. But they are saying that we are going to be paying them 162,000 in cash on 31 July 2023. How many years from now?
1 year.
Okay. So what will happen now is that assuming we have cash to pay today, we cannot pay the 162. So 162 is always going to be having the interest element, which will cover the time value of money. So we have to separate the cash payment itself from the interest. How do we do that? We present value the what? The consideration. So the present value will be the 162,000 divided by 1.08. exponent 1. So we just find the present value of that. What are we having?
150.
Okay. So you'll be having 150,000. Okay. So if the cash that we're supposed to pay, the actual cash payment, the principal payment is 150,000, but we are paying 162 in what? In a year time. It means that there is an interest element of what?
12.
Okay.
12.
There is an interest element of 12,000. But the question now is, this interest element over here is for a full year, isn't it? It's for full year, but we acquire the subsidiary on 1st August. So we are preparing the statement at December. So that is 5 months. So we only consider 5 months of the what? Of the interest cost. The remaining 7 months will be for the subsequent year. So don't take all the 12,000 to profit off. That is a full year interest. But this year we have done only 5 months of that particular acquisition period. So you do 5/12 multiplied by the 12,000. What are we having?
5,000.
That will be 5,000. Okay. So this 5,000 will be taken to the statement of profit or loss. We now add it to the parent finance cost of 5. We are keeping 3 zeros. So that will be 5. We are done with that particular one. We don't have any problem with it. In fact, the statement of profit or loss is the simplest when you come to consolidation. You don't have to do any. Yes, please.
Linus,
Yes, please. I can hear you.
please, I'm a bit confused about the dividend. Can you just highlight it small for me? I beg you.
We will come to the dividend side. We are not yet there.
Okay.
Senior,
Yes, please.
please get to the worksheet for me. No, the consolidated, the P&L side. Distribution. Okay, sir.
Okay. So, yeah, don't worry. The dividend side, if I get there, I will explain everything. Okay. B. Let's go.
You see, when we're using it for the net asset, we calculated something. Then that is
No,
where
I was trying to
confusion is.
check. I was trying to check whether part of the dividend has been paid out of the pre-acquisition profits, but I wasn't getting. The question is not giving us any information about that, so you don't have to focus on that particular side like that. So sometimes they can say the dividends has been what has been part of the dividend will be the dividend can even be paid within the what the year before the acquisition. So the question can tell you that a dividend of this amount has been paid maybe on 1st July. It means that that particular dividend will be paid out of the what? The post-acquisition profits. But since they are not saying anything like that, we will just assume that the dividend has been paid at the end of the year, which will be the post-acquisition dividends. Are you okay? All right. So let's move on. Let's move on. So what are we going to be? Footnote B.
The policy of the entity is to measure non-controlling using proportion of net asset method. Goodwill is determined to be impaired to the amount of 54,500 on 31st December 2022 and to be charged to cost of sales.
Okay, impairment of goodwill is an expense, isn't it?
Yeah.
Yes.
Okay, and the goodwill will be calculated from 1st August. So impairment of the goodwill is always going to be a post-acquisition what item, because from the beginning to 31 July, there was no issue with what goodwill. So impairment of goodwill is going to be a post-acquisition what item. So you don't have to do anything like, okay, you are trying to pro rata the goodwill, like you are doing 5 months for the post acquisition and 7 months. No, the goodwill will come into the equation from 1st August. So any impairment will be from 1st August towards to the December or to the reporting period. And they are saying that this should be charged to cost of sales. So you go to your cost of sales, you go and add your impairment of goodwill, which will be 54.5. Okay, you are done with that one too. You don't have to do anything. We are not calculating goodwill. You only calculate the goodwill if the question has asked you to do so, or you are given an impairment of the goodwill in a percentage. So you have to know the goodwill first before you know the impairment. But when you are given the impairment of the goodwill, please don't go and be doing anything like net asset acquisition, because there is no need for the goodwill unless the question is asking you to calculate the goodwill, or the goodwill impairment is given in percentage. So you have to know the goodwill before you calculate the impairment on it. So for this one, there is no calculation for goodwill. We don't need it. We don't need it. For statement of profit or loss, you are going to be the stress for calculating some of the items. You know, you don't need them. Non-controlling interest is not needed. Group return earnings is not needed. Purchase consideration might be needed if you want to calculate a goodwill, but most of the items will not be needed. Most of the workings will not be needed over here. So let's move on to the C. So we use the proportionate method where we need to use it. So let's go to the C.
C. Plant and equipment whose fair value exceeded the carrying amount by 120,000. The estimated remaining useful life of the plant and equipment of Dela at 1st August was 5 years. All depreciation of property, plant, and equipment is charged to cost of sales. Assume that the profit of Dela for the ended 31st December 2022 accrue evenly over the year.
Okay. So there is what? There is a post-acquisition, there is a fair value adjustment here. So what we do is that let's go and add that to our net asset first. So we have a PP of acquisition, that will be what? 120, isn't it?
Yes.
Okay. So what will happen? We now calculate the depreciation on that.
Yeah.
Okay. So let's count to the depreciation on the PP. Okay. So the depreciation will be 120,000 divided by what?
5.
5 years multiplied by what?
5 divided by 12.
Like
Okay.
what?
5/12. The depreciation is a full year, but we are not doing the acquisition is not a full year. The additional PP will come into play from the date of acquisition. So this increase is from the date of acquisition, which is 1st August. So depreciation charge will start from the 1st August to the end of the year. So what are we getting as the depreciation?
10,000.
One.
Okay, divided by 5 times,
10,000.
that will be 10,000. Okay.
Yes.
So we go, depreciation is an expense, and they are saying that this should be charged to what? Cost of what?
Cost.
Of sale. So we go and add a 10 here. Okay, you come and add the 10 here. Yeah, I saw the hand up. Okay, let's move on. I'm sure that is a mistake. Okay. So for that one, please, profit or loss, don't go and do net assets at reporting. The net asset at reporting, we do that to find profit. You are preparing statement of profit or loss account already. So which profit are you going to be looking for again? Okay, so let's come to, we are done with the fee part also. So there is nothing like you are going to be adding assets. No. So that is that for that. Let's come to D.
D. Brain Limited supplies a component used by Della. Brain Limited earns a profit margin of 20% on the supplies. Detail of the sales of the component and the holdings of inventory of components are as follows. Sales of the component since 1st August 2022, 100,000. Inventory of component at 31st December 2022, 48,000.
Okay. So this is intra-group what? Okay. So what do? We remove the cells. The cells should not be, we assume that there should not be any cell between the what? Between the what? The group. So we go and remove the cells. That is the first thing. We look at that one. So the parent will be recognizing 100,000 and the subsidiary will be recognizing 52,000 relating to that cells. The cells made by the buyer becomes the actual cells. So the subsidiary will be recognizing 52,000 as a cell. Why 52,000? Because the total sales was 100,000, but they were able to, they have 48,000 remaining. It means that they made a sales of 52,000. So the 52,000 should be the actual sales for the group. So if you see this one, sometimes the question can tell you that the sales to the LA were maybe 10,000 per every month. The sales were consistent. Maybe they can use a particular English there that sales to the lab were consistent throughout the year, which may be like 10,000 per month. Please, from January to July, there was no relationship or there was no what subsidiary parent subsidiary relationship. So that would be a sales to a third party. We only take into consideration the post-acquisition sales. Before you acquire the lab was just like a normal customer to you. So if you sell to the lab, you don't have any problem whether he's able to sell all of them or not. That is none of your business. But after you acquire the lab now, the lab is now your company. So you can't sell to your own company. You can only recognize all the sales if all the goods given to them have been sold. So we only take into consideration the post-acquisition sales. And this particular sale over here is the post-acquisition sale, which is from 1st August to the end of the year. So you go to your revenue, you remove the sales first. So we come here, remove the 100. We remove the 100. We remove that one from the revenue and cost of sales. But what is going to happen is that we are removing more than we should. So we calculate for what we call provision for unrealized profit and add it to the cost of sales. So let's come to provision for unrealized profit. So let me come to the next workings. So provision for unrealized profit. Okay, I want to say something about this before you do that workings. Okay, the question says that the details of the sales component and the holdings of the inventory component are as follows. Who will be the one to hold the inventory? Who will be holding the inventory?
Della.
Is the seller.
Is the subsidiary, the buyer. The seller has sold the inventory, so no inventory relating to these sales will be with the seller again. So the LA will be the one to have this inventory. This inventory will be shown in the books of the LA. So this inventory is a selling price. Okay. Unless the question is telling you that, okay, this inventory is at cost price. Unless the question is telling you that this is a cost price, of the inventory. Okay, and they will tell you the cost price to who. They can say cost price to Dela. The cost price to Dela is a selling price to what? Brain. Okay, so the inventory over here is a selling price. Okay, and you are given a margin of 20%. So what will be the profit that are here to be what? To be realized from the sale of the 48,000.
9,600.
Okay, margin is charged on sales, markup is charged on cost of what? It's charged on cost price. Okay.
Cost.
Okay, so we have margin to be 20% multiplied by the 48,000. So you don't have to change anything over there because you are giving margin and the what? The sales. So what are we having?
9,600.
Okay, so we have 9,600. So this will be added to our cost of sales. So we come here and add 9.6. Okay, we are done with that particular side. Assuming if you are given a percentage, maybe they are giving a percentage, the tax rate. If we are giving a tax rate for the parents, what we do now is that we have to calculate a deferred tax on what? On the unrealized profits. Okay, why do we have to calculate a deferred tax? The sales, the time that they were estimating their income tax, they would think that the total sales was 100,000. So the profit on the total sales, which is the 100,000, which will be 20,000, the profit was on 20,000. So the tax was estimated based on the 20,000 profit. By the end of the day, we are now having a portion of the profit which are here to be what? Here to realize to be 9,600. It means that since the profit is reducing, the income tax expense should also reduce. But we are not giving the income tax rate for the parents. So we can't do that particular provision, the deferred tax element on the what? On the provision for unrealized profits. Okay. So the tax expense was estimated on the total profit on the sale. Now you are not realizing a part of the profit. It means that the tax element on that should also be removed from the what? Our total tax expense. But we don't have the tax rate. If we should have tax rate, we have to calculate our deferred tax. That would be a deferred tax asset. We take it away from our income tax expense. But you are not going to be seeing that in the exam. They will just give you the income tax. But if something happened like that, you should have it in your mind that the provision for unrealized profit will be given a rise to what we call a deferred tax asset. Okay, let's come to so we are done with the D. Yeah, profit or loss is a soft slide. No plenty things. If it should be statement of financial position, you find the unrealized profit, you take it from group return earnings, then you now go and take it from inventory again. No stress like that. Let's move on to the E part.
Please, we are not going to use the 52,000.
No, 52,000 has already been in the revenue for the subsidiary. So
Okay.
we don't have to do anything with that. Let's come to E.
E. The investment income, which is shown in Brain Limited statement of profit or loss, represent dividends received from Dela and also dividend received from a portfolio of other equity investments. This portfolio is classified by Brain as fair value through profit or loss. The gain on remeasurement of the portfolio to the fair value at 31st December 2022 was 65,000. The gain has not yet been recognized in the financial statement of Brain Limited.
Okay, so they are saying that the investment income, which is shown in Brain Limited financial statements. So let's go there. What is the investment income? They are saying that it's consisting of what? A dividend from the subsidiary and also dividend from other equity or other investments. Okay, so let's come here. You see the dividends. Okay, Brain is part of the owners, or the Brain is the owner of what? Owner of Dela Limited, isn't it? Okay. If dividend is paid to the owners, where do we treat that particular dividend? If you are paying dividend to your shareholders, the owners, where would the dividend be treated?
Retained earnings.
Now we have a statement for that. Where would that be treated? If you are preparing final accounts and the dividend has been paid to the ordinary shareholders, where do we treat the dividends?
Statement of changes in
Equity.
equity.
Okay, statement of changes in equity. So dividend received from the subsidiary by the parent should be treated in statement of changes in equity, because the parents are the owners of what? Of the subsidiary. So dividend paid to the owners are to be treated in what? In
Statement of
statement of
changes in
changes in equity. So the dividend of that particular portion should not be in profit or loss, but the dividend received from an associate should be treated as investment income, because our investment in the associate is just like a normal investment. We are not the owners. So dividend from investment in associate are treated like a normal income, which would be in profit or loss. But dividend from a subsidiary that we are the majority owner, it will be a statement of changes in equity item. So let's go and find the portion of the dividend that we are receiving. What is the total dividend paid by the subsidiary?
160.
150.
Okay. What is our percentage holding there?
75.
So we just find a 75% of the total dividend. So let's count the dividends received from that. The dividend will give us 0.75 multiplied by 160. What are we having?
120.
Okay. So that 120 will be taken from that, and we now send it to what we call the statement of changes. So we come here and take the 120. Okay, the question is talking about some fair value gain there. So I will take this side. We need to have a fair value gain. But what I will do is that, although it's not an income, it's not money that we are receiving, it's an increase. But I don't have a place here. So, okay, let me just take the profits. Let me take this one here, and I'll bring the fair value gain here. Okay, they are saying that the investment is classified through profit or what? Loss. So the gain will be taken to profit or loss. So fair value gain of how much? 65, isn't it?
Yes.
So we have profits before tax. Then we have our tax expense now to be 240 plus 5/12 multiplied by 135. Okay, so we have profit for the year. Profit.
Signalanos.
Yes, please.
So the fair value gain, it will not be added to the investment income.
That is not income. The income that we are talking about over here, we're talking about over there is cash. It's cash that we are receiving for those ones. Okay.
Okay.
All right. So profit for the year. Okay. So let's come to what we are going to. Okay. So we are done with that side too. No big thing. Okay. So yes, we are done with the only thing that we do is that we go and take the 120. That 120 will be taken to the statement of changes in equity. The fair value gain has also been recognized. Okay, so let's come to the last part.
F. On 1st October 2022, Brain acquired 30% of the ordinary share of Venia and gained significant influence over Venia. At the acquisition date, the fair value of Venia net asset approximates their current values with the exception of a building. The building, with a remaining useful life of 10 years, had a current value of 2 million, but a fair value of 3,600,000 between 1st October 2022 and 31st December 2022. Veneer sold goods to Brain for 2 million, making a profit of 200,000. All these goods remain in the inventory of Brain. Veneer made a profit tax of 2 million.
A profit after tax. Hey, sorry.
Profit after tax 2 million for the year ended 31st December 2022 and pays tax at 20%. At 31st December 2022, the directors of Drain believe that the investment in the associate missed impairing by 50,000.
Okay, thank you. So this is the investment in associates. Okay. So what we do is that we have to now calculate the profit for the associates and take our share of it. Okay. This side is a very interesting one. So let's come here. Let's start with the profit for the profit for the year. Okay. So let's go to the investment in associates. So that will be, so let's come here and have so let me just put 7 here. Adjusted profit after tax for Veneer. Okay. So we are going to be having the items here. Okay. So let's come here. Let's put 3 zeros here. So as per the footnotes. Okay, as per the footnotes, what is the profit made for the year? What is the profit made for the year?
After tax,
Yeah, profit after tax is what?
2 million.
Yeah.
Okay. But when was these people acquired? When was the acquisition date?
1st August.
No.
No,
First
1st October, sorry.
So how many months is that?
3.
Okay. So if you want to have anything, we should have a share of 3 months profits, isn't it?
Yeah.
Yes.
So we are going to be looking for post-acquisition profits. So you do your 3/12 multiplied by 2 million, which is 2,000. What are you going to be having?
$500.
500.
Okay, that will be 500. Okay. We are going to be having something like depreciation here. Do we agree to the depreciation? There is a depreciation that has not been, there is a fair value adjustment that has not been taken into consideration at the date of acquisition for them. Okay, so let's come here. At the date of acquisition, the fair value of Veneer's net assets approximates their carrying values, with the exception of a building. The building with a remaining useful life of 10 years. The building with a remaining useful life of 10 years had a
Carrying
carrying
value of
value of 2 million, but a fair value of what? 3.6 million. So what is the fair value adjustment there? How much is the fair value adjustment?
1.6.
Okay.
1,600.
Okay. And the useful life, the remaining useful life of the building is what?
10 years.
10 years. But we are going to charge the depreciation for how many months?
3 months.
3 months.
Okay. So we come here and have our additional depreciation. That is a very interesting one. So 1,600 divided by 10 multiplied by 3/12. What are we having as the depreciation?
40.
Okay, that will be 40, isn't it?
Yes.
Okay. But you are going to, the depreciation will be an expense, isn't it?
Yeah.
Okay. I will ask you something. They have given you the tax rate. Okay. They have given you the tax rate. They have given you the tax rate of what? 20%, isn't it? Okay. Assuming you are not giving the tax rate, then you just apply the depreciation and move on. But In accounting, depreciation is what? In accounting, depreciation is tax what? Deductible, isn't it?
Yeah.
Yes.
Okay. So it means that if we should have known the depreciation earlier, if we should have known our depreciation earlier, our tax will be the 200
Reduce.
minus 40. Then we
Yeah.
charge the tax on the 160, isn't it?
Yes.
Okay. But since we don't know the depreciation, the tax was charged on what? The
A
200.
higher value. Yeah.
Okay. So it means that since we are now subtracting this, there will be a tax benefit on the depreciation there. So
Okay.
let's now come to the tax that we are paying on the depreciation. So someone can call it tax savings, or you can still adjust. Okay, you can just do your 500 minus 40 before you charge your new tax now. But let's just find the tax element on the depreciation. That will be 0.2 multiplied by 40. The depreciation is going to be reducing our tax by what amount?
So the tax rate is not 30.
No,
It's
it's 20.
30%.
Are you sure? Don't be assuming your own
20.
tax rate. Pay tax
It's
at 20%.
20.
Okay.
Where's the 20 given?
Don't be saying that the tax rate that you have been seeing always is 30%.
No, that's not what I'm assuming.
Okay. So this is 20% here. Okay. So what are we having as the portion of the depreciation?
Okay.
That will be 8.
8.
Okay. So we add the 8 here. Let's come to the issue of the provision for the unrealized profits. Okay. So we come to Venunia sold goods to Brain for 2 million, making a profit of what? 200. All these goods remain in the inventory of Brain. Okay, so what will happen is that this will also the profit are yet to be what? Realized, because this is what? This is the close. There is a close relationship between Brain and what? Venunia. But mostly what we do is that we find a portion of the unrealized profit that the parent will be taking. Then we add it to cost of sales. Or you can also adjust it against the profit. Which of them should we do? Should we find a portion and add it to the cost of sales? Or we adjust it against the profit of the associate and take our share of the profit? Okay, let me do the one.
Let's do the two and see the approach.
Okay, so what will normally happen is that the best way is always to find a parent share and add it to the cost of sales. But let's come here. We are going to be having provision for unrealized profits of 200. That is 200,000. Okay, on the goods is 200,000. So they make a profit of 200,000. All these goods remain in the inventory of Brain. So what will be our total? What will be our total profit? 500 minus 40 minus 200 plus 8. Okay. I'm having 268.
Sure.
Okay. So 268.
Is a continuation.
Okay. 268. So this 268, the parent share will be what? 30%, isn't it? So we are going to be having 30% share of this.
Depreciation is 40 rather than 10.
So what are we having? What will be the final figure that you are having? The parent is 30%.
80.4.
80.4.
0.4.
Okay. So I will show you the second one too, how you can also go about it the second way. So the second way, what you do is that you just share your profit from here. You will not bring the provision for unrealized profit. So you have your 500 minus 32. That will give you will not subtract the 200 provision for unrealized profit. You will not subtract it. So let me write alternative here. so that we can move on. So that one you'll be having the parent share of the profit will be 0.3 multiplied by 460. What are you having? I'm having 140.4.
0.4.
Okay. Then you count to the parent share of the provision for unrealized profits. Okay. So that will be 0.3 multiplied by 200. Okay. What are you going to be having? Would that be 60?
60.
Okay. So this will be treated as an expense. We add it to cost of sales, but this will be treated as what? A share of the profits. So if you look at it, you can see that at the end of the day, your share of the profit is what? 80/40, 80.40. Okay. So let's use the second one. Let's treat the 140.4 as a share of the profit, and we treat this one as an addition to cost of sale. Okay. You are not going to have any problem with that. So the share of the profit will be 140.4. Then we add the 60 to cost of sales. Okay. Let's count to, there is something that they are saying there. They are saying that the directors of Brain believe that the investment in the associates need what? Impairing by what? 50. So there will be an impairment. The investment that we have over there is impaired. It is only the investment. It is only our investment that is impaired. So the parent will take the full share of what? Of the impairment here. The parent will take the full share of the impairment. It is not the company as a whole that is impairing. It is only our investment that is impairing. What did they say about impairment of? Okay, so they are saying that the policy of the entities to validate this one is determined to be impaired to the amount of 5,000 and to be charged to cost of sales. That is the impairment for the first one. So what you can do is that this impairment will also be expense to you. So you can add it to cost of sales, or you add it to administrative expenses. There is no problem with the 50. So the parents will charge 50 as an impairment to the investments in the associates. So where are we adding it? Should we add it to cost of sales or administrative expenses? Okay. So go and add it to cost of sales because we have already added one impairment to cost of sales. So let's put our figures together because I want to show you how we share the profits. Okay. 5/12 multiplied by 2,400 plus 46.8 minus 100. What are you getting for the revenue? I'm having 5580.
Senior,
Yes, please.
the depreciation in figure 40, won't it count to cost of sales?
We have already adjusted that against the profit before we have the share of the profits.
Okay.
Okay. Unless you are sharing the total profit of the 500, it means that the depreciation is not taken into consideration. So maybe you have to bring the depreciation to the cost of sales. But we have already adjusted that against the profit. So it's supposed not to come there again. All right.
Okay. Thank you.
All right. So our list figure 3120 plus 500 plus
3704.1.
5 plus 10 minus 100 plus 9.6 plus 60 plus 50. 3704.1.
Yes.
3704.1. Okay. Then what will be our gross profit?
$1,875.9.
Okay. Let's come to our administrative expenses. What are we going to be getting? 4, okay, 5/12 multiplied by 270 plus,
552.5.
okay, so that will be 552.5. Okay, then we come to distribution. Distribution, what are we going to be having? We now have 180,
335.
okay, 260, 335. That will also be expense, 335. Okay, let's come to investment income. That will be 16, isn't it?
Yes.
Okay, then let's come to our 5/12 multiplied by 210 plus 5 plus 200. I'm having
292.5.
292.5. Okay, so let's come to share of the associate profit will be 140.4. Then the gain will be 65. Let's now have profit before tax. So let's go and have over here. We have the
296.
the gross profit, which is 1875.9 minus 552.5 minus 335 plus 16 minus 292.5 plus 140.4 plus 65. I'm getting 917.3. Okay.
Confirmed.
Okay. 917.3. Let's come to tax expense. 240. 5/12 multiplied by 85.
296.25.
Okay. So 296.25. So what will be our profit for the year?
$621.05.
Okay. So this 621.05 is the profit, is a 3-month profit for the subsidiary and a 12-month profit for what? For the parent. But we know that the parent is going to be having only 75% of the share of the associate of the subsidiary's profit. So this particular profit over here, we are going to be looking for. This profit over here is for the parent, which is a full year and a 3-month for the subsidiary. But we know that profit for the subsidiary will be shared among the parents and then the NCI. So this profit, we are going to be sharing the profit. So we call it profit attributable. The profit attributable to the profit attributable to the profit attributable to, then you have parent holding. I will show you so many ways of calculating this. You can also start from the parent perspective. You find a parent own profit. You find a parent own profit, then you find the NCI. But what we do is that we mostly find the NCI share, and that will give us this one. Okay, so let's come here. Let's start sharing from the subsidiaries what? Profit. Okay. So what is the subsidiary profit for the year? What is the subsidiary's profit for the year?
405.
Okay. But what is the profit included in the consolidated statement? Profit or loss? It's for how many months? How many month profit is included there?
3 months.
No, please.
No, 7.
We have included only 5 months profits. So 5/12 times 45,000. Okay, what is the answer that you'll be getting?
It's 8.75.
Okay, so the profit that is the subsidiary's profit over here is only 5 months profit. But this profit, this 5/12, this profit is before taking into consideration certain what? post-acquisition what adjustments, and the first post-acquisition adjustment will be what impairment of what goodwill. The goodwill that is impairing is relating to what is relating to the subsidiary. So we take the impairment of the goodwill from that to be 54.5. That is the first adjustment that we are going to be doing. It has not been captured in the 5-month profit. The 405 over here is just a profit without taking into consideration the post-adjustment what items. So the first one is the impairment of the goodwill. What will be the second one?
Income.
The second one will be a depreciation on the what? On the item. So we have calculated a depreciation. Okay. Let me just do the easiest way of doing this. Assuming we are preparing a net asset, you see that the depreciation will be taken away from the reporting figure, isn't it?
Yeah.
Okay. So that adjustment is what we are doing here because we know the profit already. But for the net asset, we don't know the profit. So that is why we put the depreciation there to take it from the what? From the net profit there. But right now we know the net profit already. So we just adjust the depreciation against it. So we have calculated that depreciation already. That was 120 divided by 5 multiplied by 5 months. I hope we have done that. We have gotten a certain item there. Okay.
10.
The depreciation was 10, isn't it?
10,
Yes.
yeah.
Okay. So that particular 10 should also be taken from our profits. Okay. I'm sure we don't have any other adjustment to the subsidiary again. So you always start with adjusting the subsidiary's profit, then you find the NCI for it. So the intra-group, it is the parent that is selling. So we are not going to have any unrealized profit for that. And this one too, it is for, so they are only two, the impairment of the goodwill and also the depreciation, the additional depreciation that is coming there. So let's now find our post-acquisition profits, and NCI will take 25% of that. Okay, so 5 over 12, 5 over 12 multiplied by 405 minus 64.5. So 104, NCI will take 25% of that. Okay, so I'm having the NCI share to be 26.0625. Is that correct?
Yeah.
Yes.
Okay. What is the total profit for the year?
621.05.
So if NCI is taking that, then it means that the remaining portion will be for the parent, isn't it? So you just take the NCI share of this, and you have that particular one. Okay. So minus 621.05. Okay. I'm having 594.97. The reason why I'm not approximating this is that we are the one keeping 3 zeros. Like we are not keeping 3 zeros. These figures should have been absolute figures. Okay. So we have the 621.05 to be the total profit. Okay. I'll also show you another way of calculating the NCI share without adjusting the subsidiary's profit. But adjusting the subsidiary profit is the easiest way to go about it. Is the easiest way to go about that. Okay. We can also do this by adjusting the parent's profits. We can also do this by just looking for the profit that relates to the parent itself. What is the parent profit for the year? What is the parent profit? It's 556, isn't it? Okay. So let's go and look at the items that we have adjusted against the parent profit. The items that we have adjusted against the parent profit. So the 556, okay, this is including a dividend of 120, which should not be there. So we take the dividend out of it. Okay. We are also having unrealized profit of 9.6, which is a sales that's relating to the parent. So that 9.6 should also be taken away from here. Okay. We also have
Impairment.
now the impairment will not affect. Okay, the 50 will affect the 50 will affect the parents. And the parent is having a share of what? 140.4, isn't it? That has not been taken into consideration. There is a fair value gain of 65. That has not been taken into consideration. And we also have the finance cost of what? The deferred consideration. There's a finance cost of
5.
there's a finance cost of 5. That has also not been taken into consideration. Where are we getting the 60 from? We do something and we have 60.
The
Okay.
the provision for unrealized profit.
Okay, so that has not also not be taken into consideration. So we also have the 5, which is additional interest, that has also not been taken into consideration. So we have profits, we have the gain that has been taken into consideration. What are the items that are relating to the parents? The 10 is the subsidiary, 9.6 is the parent, 60 and the 50. Okay, so you now adjust the parent profit. What will be the actual profit for the parents? 556 minus 120 minus 9.6 minus 50 plus 140.4 plus 65 minus 65. Okay, I'm having 516.8. Is that correct?
Yes.
Okay, so this is the parent profit. So out of this total profit, that is a portion for the parent. So you just take the parent one from this 621.05. What are you going to be having? 140.25. Is that the figure?
Yes.
Okay, and this is the profit that is for the subsidiary. So if you adjust this one, this is the figure that you have gotten. So you don't have to adjust the subsidiary's profit again. You just adjust the parent one. What is the parent profit in this? The remaining one will be for the subsidiary. And the adjustment of this one is still the 140.25. So you just multiply the NCA share on it, which will be the 26.05. But the easiest way is to adjust the subsidiary's what? Profit, because the adjustment relating to the subsidiary will not be that much if you come to this. Please, let's determine our NCI. Okay, the NCI is a proportionate of the net asset at acquisition. So 1665 plus 236.25 plus 120. I'm having 2021.5. So NCI will be 25% of that. So what are we having as the NCI? 0.25. I'm having 505.31325. Okay, so our NCI will not have any opening balance, but we come to at acquisition. At acquisition, that will be dash. Then we now have our NCI to be 505.3125. Okay, what are the additions and the subtractions that will come to statement of changes in equity? What are the things that will be adding and that will be reducing? We have profit for the year. Okay, the profit for the year, you bring their share here. The parent is having 594.9875. NCI is having what? 26.025. Okay. What is the other item that is going to be coming here? We have profit for the year to come here. Then we have, okay. Then we come to dividend paid by the parents. Dividend paid by the parents. What is the dividend paid by the parents? That has been given to us. Dividend paid by the parents will come as a reduction. So what is the dividend paid by the parents? The dividend paid by the parents.
Is it 200?
No, that is 400. Okay. So the dividend will be a reduction here. Okay. And the dividend paid by the what? By the subsidiary is what? Is 160. But this 160, we share it among the what? The NCR and then the parents. So NCR will take 25% of that. So let me just put dividend paid here. Okay. So the dividend paid over here, I'll bring both the NCI and then the parent own. So 0.25 multiplied by 160. NCI will receive a dividend of 40. That will be a reduction to them. Then we come to the dividends received. The dividends received will be, the parent will receive a dividend of 120 from the NCI, and that will also be a dividend paid again. So let me just put a total dividends paid here. So let me add, that will be 420 here. Okay, 420. So the parents, so the dividend that is being paid by the NCI, we don't even bring it to the parent what statement of changes in equity, because it will come as an outflow the same time an inflow. So the parent will receive it as an income. But if you are charging the dividend paid by the subsidiary, the 120 will be, they paid 160. That was paid out of profit. 120 will be for the parent as an outflow. 640 will be for the NCA as an outflow. And the parent will still receive the 120 as inflow. So at the end of the day, we don't bring the dividend that is being paid by the subsidiary to the parents.
Lano,
Yes, please, I can hear you.
please take it again, the dividends paid.
I'm saying that the dividend that the subsidiary is paying, it will be taken from the parent figure, because they are paying 160. The 160 is paid out of profit. So the 160 will not be shared among the parents and then the NCI. The parent will take 70%. The NCI will take 20%. So we have a reduction of 120 from the parent, 40 from the NCI. But the parent will still receive this dividend as an income. So it will also come as an income. At the end of the day, we don't bring it at all, because it will be an outflow of 120, inflow of 120. So this is supposed not to be here in the first place. So you just put all the 400 here as the dividend paid by the parent itself, because the one that is being paid by the subsidiary will be an outflow, at the same time will be an inflow. So we don't bring it at all, because it will be canceling out. It will be doing what we call the set off. So you just total this, and this is the figure that you send to your statement of financial position. Just total that, and that is the end. Any question?
Senior, the NCI calculation at the statement of profit and loss account. In fact, I don't know what is from my calculator. I'm not getting the figure.
You find the 5% of the profit before you subtract, then you multiply by 2. So this will be done first. If you are putting all of them into the calculator will be using board mass, and the figure you'll be getting will be different. So do this one first. It will be the 5-month profit. Then we now adjust. These are post-acquisition items. Then you take it from that. You'll be getting 104.25.
Okay.
Lano,
Yes, please.
the net asset at acquisition. Why are we not bringing the parents here?
No, the parents here will cancel the consideration that they are paying, so we don't do anything. The best that
No,
they can have is the goodwill.
no, okay.
Okay, so you can continue with the rest. So we are going to solve. So from next week, Wednesday, financial reporting people, you are going to be leaving us. We are going to enter advanced consolidation, which is a way. So pass the normal consolidation first, the basic one first, so that you come, we do the advanced one. So for next week, the financial reporting people, you should not be joining again because we have a lot of things to learn. So don't come and confuse yourself. So yeah,
we will start on, is it relief on Tuesday or Wednesday?
Wednesday. Tuesday, we look at basic consolidation again. Maybe a question on a combined one where they will be asking you to prepare both the statement of financial position and the statement of profit or loss in one question. After that, go and do your own thing. Okay. So that is that. I'll see you guys. Enjoy your day. Have a very good morning and a very good day. All right.